Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Hello students, I, Dr. Dhaval from Gujarat University, welcomes you all to the fifth and final part of accounting concepts, conventions and principles and accounting standards. In the previous module, we had discussion on accounting standards which are having vital role in preparation and presentation of annual financial statements. We had acquired information about meaning, need and importance of accounting standards, preliminary understanding about accounting standards. Here we have covered accounting standards from 1 to 11. Now, in this last part of accounting concepts and accounting standards, we will study objectives of remaining accounting standards from AS 12 to AS 29. Their titles are AS 12 Accounting for Government Grants, AS 13 Accounting for Investments, AS 14 Accounting for Amalgamations, AS 15 Employee Benefits, AS 16 Borrowing Cost, AS 17 Segment Reporting, AS 18 Related Party Disclosures, AS 19 Leases, AS 20 Earning per Share, AS 21 Consolidated Financial Statements, AS 22 Accounting for Taxes on Income, AS 23 Accounting for investments in associates in consolidated financial statements, AS 24 Discontinuing operations, AS 25 Interim financial reporting, AS 26 Intangible assets, AS 27 Financial reporting of interest in joint ventures, AS 28 Impairment of assets, and lastly AS 29 Provisions, contingent liabilities and contingent assets. In this part, we will commence with AS 12, that is AS 12 Accounting for Government Grants. The receipt of government grants by an enterprise is significant for preparation of the financial statements for two reasons. Firstly, if a government grant has been received, an appropriate method of accounting therefore is necessary. Secondly, it is desirable to give an indication of the extent to which the enterprise has benefited from such grants during the reporting period. This facilitates comparison of an enterprise's financial statements with those of prior periods and with those of other enterprises. In this regard, this AS is issued. Now, we will see the objectives. The standard deals with accounting for government grants. Government grants are sometimes called by other names such as subsidies, cash incentives, duty drawbacks, etc. This standard does not deal with the following: the special problems arising in accounting for government grants in financial statements, reflecting the effects of changing prices or in supplementary information of a similar nature. Government assistance other than in the form of government grants, government participation in the ownership of the enterprise. Now, we will look the AS 13 Accounting for Investments, which is revised in 2016. Investments are also one of the important opportunities where funds are invested. Enterprises hold investments for diverse reasons. For some enterprises, investment activity is a significant element of operations, and assessment of the performance of the enterprise may largely or solely depend on the reported results of these activity. There are some other reasons for investments recognition and disclosure. These AS deals with all kinds of issues pertaining to investments. Now, we will see the objectives of this particular AS. This standard deals with accounting for investments in the financial statements of enterprises and related disclosure requirements. This standard does not deal with A. The basis for recognition of interest, dividends and rentals earned on investments which are covered by Accounting Standard 9 on revenue recognition. B. Operating or finance leases. C. Investment of retirement benefit plans and life insurance enterprises. And D. Mutual funds and venture capital funds and or the related asset management companies, banks and public financial institutions formed under a central or state government act or so declared under the Companies Act 2013. Now, we will see AS 14, which is revised in 2016, accounting for amalgamations. Amalgamation means combination of two companies. There are two types of amalgamations. One, amalgamation in the nature of merger, and number two, amalgamation in the nature of business purchase. Both amalgamations have different objective and their accounting treatment are also different. These AS clarifies all technical aspects pertaining to amalgamation. Objectives: this standard deals with accounting for amalgamations and the treatment of any resultant goodwill or reserves. This standard is directed principally to companies, although some of its requirements also apply to financial statements of other enterprises. This standard does not deal with cases of acquisitions which arise when there is a purchase by one company referred to as the acquiring company of the whole or part of the shares or the whole or part of the assets of another company which is referred as the acquired company in consideration for payment in cash or by issue of shares or other securities in the acquiring company or partly in one form and partly in the other form. The distinguishing feature of an acquisition is that the acquired company is not dissolved and its separate entity continues to exist. Now, we will see AS 15, employee benefits, which is revised in 2005. In these AS, employee related benefits are covered. Employee benefits are all forms of consideration given by an enterprise in exchange for services rendered by the employees. How these benefits should be reflected in accounts is recommended. Now, objectives. The objective of this standard is to prescribe the accounting and disclosure for employee benefits. The standard requires an enterprise to recognize a liability when an employee has provided service in exchange for employee benefits to be paid in the future, and b an expense when the enterprise consumes the economic benefits arising from services provided by an employee in exchange for employee benefits. Now, we will see AS 16, borrowing cost, which is issued in 2000. In case of imports and exports, business transactions payment may be paid in foreign currency. These transactions may be required funds in foreign currencies. Exchange differences arising from foreign currency borrowing and considered as borrowing cost are those exchange differences which arises on the amount of principal of the foreign currency borrowings to the extent of the difference between interest on local currency borrowings and interest on foreign currency borrowings. Thus, the amount of exchange difference not exceeding the difference between interest on local currency borrowings and interest on foreign currency borrowings is considered as borrowing cost to be accounted for under this standard, and the remaining exchange difference, if any, is accounted for under AS 11, the effect of changes in foreign exchange rates. For this purpose, the interest rate for the local currency borrowings is considered as that rate at which the enterprise would have raised the borrowings locally had the enterprise not decided to raise the foreign currency borrowings. These AS helps to eliminate any sort of ambiguity in this context. Objectives. The objective of this standard is to prescribe the accounting treatment for borrowing cost. Now, we will move forward on AS 17 segment reporting, which is issued in 2000. Given objectives are explain relevance of these AS. The objective of this standard is to establish principles for reporting financial information about the different types of products and services an enterprise produces and the different geographical areas in which it operates. Such information helps users of financial statements. Number A, better understanding the performance of the enterprise. B, better assess the risk and returns of the enterprises. And C, make more informed judgments about the enterprises as a whole. Many enterprises provide groups of products and services or operate in geographical areas that are subject to different rates of profitability, opportunities for growth, future prospects and risk. Information about different types of products and services of an enterprise and its operations in different geographical areas, often called segment information, which is relevant to assessing the risk and returns of a diversified or multi-locational enterprise, but may not be determined from the aggregated data. Therefore, reporting of segment is widely regarded as necessary for meeting the needs of users of financial statements. Now, we will see AS 18 related party disclosure, which is issued in the year 2000. There can be some transactions with related parties. Parties are considered to be related if at any time during the reporting period one party has the ability to control the other party or exercise significant influence over the other party in making financial and or operating decisions. There should not be any undue benefits to related parties. Thus, for safety and control purpose, this accounting standard is issued. Now, we will see the objectives. The objective of this standard is to establish requirements for disclosure of A. Related party relationships and B. Transactions between a reporting enterprise and its related parties. Now, we will see AS 19 leases, which is issued in the year 2001. A lease is an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. There are different types of leases, like a finance lease is a lease that transfers substantially all the risk and rewards incident to ownership of an asset. An operating lease is a lease other than a finance lease. And third, a non-cancelable lease is a lease that is cancelable only upon the occurrence of some remote contingencies or with the permission of the lessor, or if the lessee enters into a new lease for the same or an equivalent asset with the same lessor, or D. upon payment by the lessee of an additional amount such that at inception continuation of the lease is reasonably certain. There are several technical aspects of these leases which may create dispute between concerned parties. To minimize the level of dispute, these AS is useful. Now, the objectives. The objectives of this standard is to prescribe for lessees and lessors the appropriate accounting policies and disclosure in relation to finance leases and operating leases. Now, we will see AS20 earnings per share, which is issued in the year 2001. Equity earnings per share is always affected by issue or reduction of different sources of finance like preference share, debentures, etc. An enterprise should present basic and diluted earnings per share on the face of the statement of profit and loss for each class of equity shares that has a different right to share in the net profit for the period. And an enterprise should present basic and diluted earnings per share with equal prominence for all periods presented. To meet such needs, this AS is used. Objectives. The objective of this standard is to prescribe principles for the determination and presentation of earnings per share, which will improve comparison of performance among different enterprises for the same period and among different accounting periods for the same enterprise. The focus of this standard is on the denominator of the earnings per share calculation. Even though earnings per share data have limitations because of different accounting policies used for determining earnings, a consistently determined denominator enhances the quality of financial reporting. Now, we will see AS21 consolidated financial statements, which is revised in the year 2016. In practice, several big concerns are acquiring more than 50% shares of a small companies. Share purchasing company is known as the holding company and the other is known as the subsidiary company. To provide standalone and consolidated financial statements of holding and subsidiary company, these AS is used. Due to these AS, shareholders of holding company can see individual and combined financial performance through consolidated financial statements. Objectives. The objective of this standard is to lay down principles and procedures for preparation and presentation of consolidated financial statements. Consolidated financial statements are presented by a parent, which is also known as the holding enterprise, to provide financial information about the economic activities of its group. These statements are intended to present financial information about a parent and its subsidiary or subsidiaries as a single economic entity to show the economic resources controlled by the group, the obligation of the group and results the group achieves with its resources. Now, we will see AS22 accounting for taxes on income, which is issued in 2001. Taxable income is calculated in accordance with tax laws. Some circumstances, the requirement of these laws to compute taxable income differ from the accounting policies applied to determine accounting income. The effect of this difference is that the taxable income and accounting income may not be the same. In this case, how to deal with tax related issues, these AS is used. Now, we will see the objectives. The objective of this standard is to prescribe accounting treatment for taxes on income. Taxes on income is one of the significant items in the statement of profit and loss of an enterprise. In accordance with the matching concept, taxes on income are accrued in the same period as the revenue and expenses to which they relate. Matching of such taxes against revenue for a period poses special problems arising from the fact that in a number of cases taxable income may be significantly different from the accounting income. This divergence between taxable income and accounting income arises due to two main reasons. Firstly, there are differences between items of revenue and expenses as appearing in the statement of profit and loss and the items which are considered as revenue, expenses or deductions for tax purposes. Secondly, there are differences between the amount in respect of a particular item of revenue or expense as recognized in the statement of profit and loss and the corresponding amount which is recognized for the computation of taxable income. Now, we will see AS 23 accounting for investments in associates in consolidated financial statements, which is issued in the year 2001. There is another form of business where parent company has significant influence on other company, which is known as associate company. Like holding and subsidiary companies, consolidated financial statements of parent company are prepared to provide transparent and total picture to the shareholders. How consolidated statements of a parent company are to be prepared is covered under these AS. Now, we will see the objectives. The objective of this standard is to set out principles and procedures for recognizing in the consolidated financial statements the effect of the investment in associates on the financial position and operating results of a group. Now, we will see AS 24 discontinuing operations, which is issued in the year 2002. Discontinuing operations widely adversely affecting interest of shareholders and all other stakeholders, and thus to protect the interest of stakeholders these AS is used. Objectives. The objective of this standard is to establish principles for reporting information about discontinuing operations, thereby enhancing the ability of users of financial statements to make projections of an enterprise's cash flows, earning generating capacity and financial position by segregating information about discontinuing operations from information about continuing operations. Now, we will see AS 25 interim financial reporting, which is issued in the year 2002. Interim financial report can be presented by enterprises. This report is to be provided by following Accounting Standard 25. In this standard, what is to be provided and how it is to be presented is covered. Interim period is a financial reporting period shorter than a full financial year. Interim financial report means a financial report containing either a complete set of financial statements or a set of condensed financial statements as described in this standard for an interim period. Objective. The objective of these standards is to prescribe the minimum content of an interim financial report and to prescribe the principles for recognition and measurement in a complete or condensed financial statements for an interim period. Timely and reliable interim financial reporting improves the ability of investors, creditors and others to understand an enterprise's capacity to generate earnings and cash flows, its financial conditions and liquidity. Now, we will see AS 26 intangible assets, which is issued in the year 2002. In present times, importance of intangible assets is significantly increased. Enterprises frequently expend resources or incur liabilities on the acquisition, development, maintenance or enhancement of intangible resources such as scientific or technical knowledge, design and implementation of new processes or systems, licenses, intellectual property, market knowledge and trademarks, including brand names and publishing titles as well. Common examples of items encompassed by these broad headings are computer software, patents, copyrights, motion picture films, customer list, mortgage servicing rights, fishing licenses, import quotas, franchises, customer or supplier relationships, customer loyalty, market share and marketing rights. Goodwill is another example of an item of intangible nature which either arises on acquisition or is internally generated. Dealing with intangible assets is also important like tangible assets. For recognition, measurement and disclosure of intangible assets, these AS is used. Objective: the objective of this standard is to prescribe the accounting treatment for intangible assets that are not dealt with specifically in another accounting standard. This standard requires an enterprise to recognize an intangible asset if and only if certain criteria are met. The standard also specifies how to measure the carrying amount of intangible assets and requires certain disclosures about intangible assets. Now, we will see AS 27 Financial Reporting of Interest in Joint Ventures, which is issued in the year 2002. Joint venture is a contractual agreement between two or more parties. This form of business is different than regular business. This requires different accounting treatments. Proportionate consolidation is a method of accounting and reporting whereby a venturer's share of each of the assets, liabilities, income and expenses of a jointly controlled entity is reported as separate line items in the venturer's financial statements, and for this purpose special AS is issued. Objective: the objective of this standard is to set out principles and procedures for accounting for interest in joint ventures and reporting of joint venture assets, liabilities, income and expenses in the financial statements of venturers and investors. AS 28 Impairment of Assets, issued in 2002. Sometimes assets of business organization have very low market value against its book value. This kind of situation depicts wrong financial picture of business entity. How to deal with kind of loss provisions are given in this AS. Objective: the objective of this standard is to prescribe the procedures that an enterprise applies to ensure that its assets are carried at no more than their recoverable amount. An asset is carried at more than its recoverable amount if its carrying amount exceeds the amount to be recovered through use or sale of the asset. If this is the case, the asset is described as impaired and this standard requires the enterprise to recognize an impairment loss. This standard also specifies when an enterprise should reverse an impairment loss and it prescribes certain disclosures for impaired assets. Now, we will see the last AS 29 Provisions, Contingent Liabilities and Contingent Assets. We have already studied about provisions, contingent liabilities and contingent assets. Provisions are estimated amount provided for future needs. The happening of contingent liabilities and assets is also not certain. In this situation, to avoid subjectivity for such instances, this AS is used. Objective: the objective of this standard is to ensure that appropriate recognition criteria and measurement bases are applied to provisions and contingent liabilities and that sufficient information is disclosed in the notes to the financial statements to enable users to understand their nature, timing and amount. The objective of this standard is also to lay down appropriate accounting for contingent assets as well. Basically, accounting standards are providing mandatory guidelines to the concerned business enterprises for recognition of transactions and events, measurement of transactions and events, valuation of transactions and events, and disclosure of transaction and events. In these last part of accounting concepts and accounting standards, we have studied objectives of remaining accounting standards from AS 12 to AS 29. Now, we will meet for unit number 2, accounting for non-trading concerns, where we will discuss about meaning of non-trading concern, difference between trading and non-trading concern, difference between receipt and payment account and income and expenditure account, preparation of receipt and payment account, income and expenditure account and balance sheet of non-trading concerns with simple adjustments, practical problems of clubs and hospitals. Thank you students. I hope you have enjoyed this session. Thank you very much.